Return calculations and composites. Return calculation is a foundational component of the Global Investment Performance Standards, GIPS, because accurate performance measurement is essential for fair representation and meaningful comparison of investment results. Investors rely on performance information when evaluating managers, selecting investment strategies, and monitoring portfolio outcomes. Consequently, GIPS establishes detailed requirements regarding how returns should be calculated and reported. Consistent methodologies help ensure that reported performance reflects actual investment results rather than differences in calculation techniques. Standardized return calculations improve transparency, comparability, and credibility across firms and markets. By reducing inconsistencies in performance reporting, GIPS enables investors to evaluate managers more effectively and promotes greater confidence in the integrity of investment performance information. A central objective of return calculation under GIPS is to accurately reflect the investment experience of portfolio management decisions. Performance calculations should isolate the effects of investment skill from external influences whenever possible. The standards emphasize the use of total return, which incorporates both income and capital appreciation. Total return provides a more comprehensive measure of portfolio performance because it captures all sources of value creation available to investors. Income may include dividends, interest payments, and other cash distributions, while capital appreciation reflects changes in asset prices. By combining these components, total return offers a complete assessment of portfolio results and supports more meaningful performance evaluation. Portfolio valuation plays a critical role in accurate return calculation. Reliable valuations are necessary because performance measurement depends on the ability to determine beginning and ending portfolio values consistently. GIPS requires firms to use fair value principles when valuing assets. Fair value reflects the amount at which an asset could be exchanged between willing market participants under normal market conditions. Accurate valuation becomes particularly important when portfolios contain illiquid securities, alternative investments, or complex financial instruments. Consistent valuation practices reduce the risk of distorted performance results and improve comparability across portfolios and firms. Strong valuation procedures therefore represent a fundamental element of compliant performance reporting. External cash flows present an additional challenge in return calculation because contributions and withdrawals can significantly affect portfolio values. GIPS seeks to ensure that performance results primarily reflect investment management decisions rather than investor-directed cash flow activity. Time-weighted rates of return are commonly used because they minimize the impact of external cash flows and isolate the effects of portfolio management. This approach allows investors to evaluate manager skill more effectively by removing distortions caused by the timing and size of contributions or withdrawals. Accurate treatment of cash flows is therefore essential for generating meaningful performance results and maintaining consistency across different portfolios and reporting periods. The concept of composites is another cornerstone of the GIPS framework. A composite is an aggregation of one or more portfolios that share a similar investment mandate, objective, or strategy. Rather than presenting the performance of individual portfolios selectively, firms must group comparable portfolios into composites and report composite-level performance. This requirement promotes fair representation by preventing firms from highlighting only their most successful accounts. Composite reporting provides investors with a broader view of how a strategy has performed across all relevant portfolios. As a result, composites improve transparency and help ensure that performance presentations accurately reflect the manager's implementation of a particular investment approach. Composite construction requires clear and consistent policies. Firms must define composite inclusion criteria based on investment objectives, mandates, and strategies. All actual, fee-paying, discretionary portfolios that meet the established criteria must generally be included in the appropriate composite. This requirement prevents selective inclusion or exclusion of portfolios based on performance outcomes. Composite definitions should remain consistent over time unless legitimate changes to investment strategies or organizational structures occur. Maintaining well-documented composite construction procedures supports transparency, comparability, and compliance with GIPS requirements. Proper composite management is therefore essential for preserving the integrity of performance reporting and manager evaluation. Composite reporting involves more than simply presenting returns. Investors require additional information to interpret composite performance accurately and evaluate associated risks. GIPS therefore requires disclosures regarding benchmark comparisons, composite descriptions, asset levels, dispersion measures, and other relevant information. These disclosures help investors understand the characteristics of the strategy and assess the consistency of portfolio results within the composite. Benchmark comparisons are particularly important because they provide context for evaluating relative performance. Composite-level reporting enables prospective clients to gain a more comprehensive understanding of a manager's capabilities while reducing the risk of misleading performance presentations based on isolated portfolio outcomes. Together, return calculations and composites form the foundation of credible performance reporting under GIPS. Accurate return calculation ensures that investment results are measured consistently and reflect genuine portfolio management decisions. Composite construction ensures that performance is presented fairly across groups of similarly managed portfolios rather than selectively highlighting favorable outcomes. These principles support transparency, comparability, and investor confidence throughout the investment management industry.